Well, my experience going back over a long career, I'm a trained chartered accountant, and I worked as an auditor, looking at large insurers, fund managers and banks, global banks, looking at their balance sheet, looking at their investments and the risks around that. So that's definitely helped in my current role in the team, as I've seen various parts of the market over various points in time, and I'm seeing risks from a different viewpoint, different asset classes, our own asset class. After being an auditor, I then worked at one of the large investment banks in risk and accounting roles, and then as an analyst on the trading floor. And that was very insightful. I learnt how balance sheet risk was managed from an investment bank's point of view, but also how securities were created and dealt with, from origination through to intermediaries, through the pricing, the secondary market pricing as well. So that gave me some skills and insights which then I could bring to managing money and helping the team formulate strategies. And it was not only particularly those roles, but it was also the points in time that I was there, and through different very volatile points in time, such as the tech bubble, the Y2K issue, September 11, and then later the GFC. So all these events were quite useful in terms of, it was stressful at the time and interesting, but they were lessons learnt, and they help us adapt to current market conditions and events going forward. I guess first and foremost, I think it's important to think of ourselves as an investor, a custodian of our clients' savings. I mean, the return of that capital is more important than the return on capital. So I think we have to have an investor mindset and be very sceptical with risk. But that being said, we're being paid by our investors to invest, and we don't want to be too risk averse. We need to invest, but invest sensibly. We don't want to be risk seeking. So I think we want to screen for quality and invest where risk is rewarded. So it's about having a relative value mindset with quality investments. Also, I think it's helpful to think, I guess, like a lender in credit and fixed income, looking at those 3 C's of credit: cash flow, collateral and character. And I think if we think like that, if we get that right and we have a relative value mindset and we're risk aware, that's the best way to actively manage our investors' money. We have a well-developed credit and fixed income market, and it is continuing to evolve and expand and become more extensive. We're having greater sectors, greater number of issuers, greater and larger issuance and across various tenors as well. So that creates a larger market, more opportunities, and with that has become also more participants. So not only do we have large participants domestically, we also have participants from various overseas jurisdictions. Asia's been particularly increased investor in our market, and that results in another form of liquidity and another market dynamic. That's a great opportunity. So the opportunity set's increased, and being an active investor, we want a larger opportunity set, and that's continuing to evolve. But with that becomes risks that you have to manage, but that's risks that we want to manage, and it's a good thing for investors. So it means more issuers, more sectors, different forms of the market. So as mentioned before, that private offering and securised market continues to get larger and evolve, but we're excited about it. It's going to be great for our investors. Well, particularly in bonds and fixed interest, absolute performance is largely driven by changes in cash rates and the yield curve. So we all know where the cash rate's at. Going out the yield curve for different tenors, the pricing there is driven by cash rate expectations and some form of term premium. And they change over time, and sometimes they're static and other times they move quite a bit. So we've just been through a period of the last 10 to 20 years where inflation in a monetary policy regime which has inflation targeting, and we've had low inflation or declining inflation. Interest rates have been going down, yield curves have been going down, and there was a lot of absolute strong performance in bonds. Then we hit COVID, and then we had a lot of inflation coming out of COVID, and we had a reduction in trade, and rates and yields increased to levels not seen for a decade or more. So going forward, drivers will be what is the inflation outlook? So it's been moderating to date, whether it continued to do so or whether it may re-emerge. And also credit premiums and the credit outlook and what spread we get for other credit investments we make. And I think as the credit market evolves and continues to extensively increase, the opportunity set is great. There's always be opportunities for investors and for us to take advantage of. We're highly acutely aware of the fact that return of capital is more important than return on capital. The first point in investment in our sphere, in our funds, is to screen out bad risks. So for every security that enters the portfolio, we're doing a full analysis on that security to make sure that the default risk is acceptable, or that there's no default risk, or it's not likely to default. And once we think it's creditworthy, it's also reviewed by a delegated credit authority as a second set of eyes over the risk. Once it's then approved, we then work out, well, how much return to be required for that risk. And so we're focused on risk-adjusted returns for clients. And so we'll also focus on, and that's an interaction with the portfolio managers with the analysts. And then also, once that's determined, there'll be different points in time when it will go in the portfolios and out, and that will be varying on the change in the credit profile of the issuer. But also, what may vary is position size as well. For riskier investments, typically we'll have less allocation, and that's just a risk management tool. So as well as diversification, there's risk sizing of issuer exposures and also sector exposures as well. They are some important core portfolio management skills to utilise and implement for strategy management. Secondly, we look at overall our credit exposure for the funds. Depends on our credit outlook. We meet fortnightly to develop a credit macro score on the markets, and that sets an overall level of credit risk in portfolios in terms of credit duration, credit market value exposure, and then and cash levels. And in addition to that, we look at a range of market subsectors such as rating bands, maturity spectrums, and industry sectors. And we assess areas which are cheap, neutral, and expensive, and we'll have a range of preferences for them. And when we do that, when we allocate towards rewarded risk areas and take away allocations from expensive areas, we think that gives better outcomes for investors. We do that by meeting fortnightly as a team and creating a credit score or a credit macro outlook for the market. And that can be range from +4 to -4. And that sets the scene for how much sector allocation we want to credit, how much credit risk to put in a portfolio in terms of credit duration, market value, exposure, and also then on a more subsector level, what ratings bands we want to invest in, what part of the curve we want to invest in. But then also we look at individual industry sectors and which ones we prefer and which ones we least prefer. And we examine that together as a team with all our analysts who cover specific sectors and issuers and get their feedback. And we sort of look at separately the outlook for that sector, but then also the relative value. What is it paying and how does that compare to the other sectors? So once we have a preference suite, we will then look to invest in the portfolio, the various strategies based on those matrix of preferences and that broad credit outlook. Well, our active fixed interest strategy is a core bond fund for investors. It provides income and a core diversified to equity risk. And it does so by investing in a range of corporate and government securities. The way we manage that is we manage it, I guess the core risks in that portfolio or that strategy is credit risk and duration risk. And we manage those two risks separately through independent processes. So credit risk we manage through a bottom-up and a top-down approach. And we seek to add value by actively managing the portfolio through sector and subsector allocations and relative value trading. With interest rate risk, with duration, we tightly manage that in terms of a risk sense, and we think the value add the opportunities are not as strong as is in credit. However, there are opportunities, and the way we approach those opportunities and that risk is we look to invest at compelling valuations rather than trying to forecast where rates are going, where the market's going to be moving. It's fairly efficient. However, you can capture opportunities at compelling valuations when there is movement. So that's how we approach those two risks in that strategy.